Welcome to The Explainer. Today, we are breaking down one of the most important and honestly, one of the most overlooked parts of building wealth today: how to build an investment portfolio that's truly global.
So let me just start by asking you a really crucial question. Take a hard look at your own portfolio. Is it really telling you the whole story? Or is it maybe missing a huge piece of the global economic puzzle?
Because here's the reality of it. While the US is, the biggest single market out there, it only makes up about 60% of the world's total stock market value. That means a full 40% of the opportunity, the growth, the innovation, all of that, it lies outside US borders.
Okay, let's really get into this. Here's our roadmap for today's explainer. We're going to start with a really common mistake, then we'll make the data-driven case for going global, map out the landscape, tackle the big risks, and then we'll finish with a plan you can actually use.
First up, we've got to talk about something called the home bias trap. We really need to understand this because it's a common and surprisingly costly mistake that a ton of investors make, and a lot of times they don't even know they're doing it.
It's a totally natural instinct, right? We invest in what we know, the companies we see every single day. But that feeling of comfort, of familiarity, well, it comes at a very real price.
And that price can be pretty steep. The data suggests that by concentrating too much in U.S. stocks, you could be giving up as much as 1.5% in returns every single year. Now, that might not sound like a lot, but believe me, when that compounds over an entire investing lifetime, it adds up to a massive difference.
And this quote just illustrates the problem perfectly. When you just ignore 40% of the world's companies, you're basically playing poker with half a deck. You're just leaving a huge part of the game on the table and limiting your chances of drawing a winning hand.
So, okay, if home bias is the problem, what does the solution really look like? Let's forget feelings and look at the hard data. Let's make the case for going global.
Just think about the so-called lost decade for U.S. stocks. From 2000 to 2009, the S&P 500 actually lost value. It went backward. If you only invested in the U.S. during that time, you lost money. But meanwhile, emerging markets didn't just grow, they absolutely exploded, returning over 150%.
But then, in the very next decade, what happened? The roles completely flipped. U.S. stocks went on a phenomenal run, while emerging markets kind of lagged behind. And this proves a fundamental truth of investing. Market leadership is always rotating around the globe.
Over the long run, being able to capture that rotation makes a real tangible difference in your wallet. A globally diversified portfolio grew 14% more than a US-only one over this period. And why? Simply by being exposed to the world's winners no matter where they were located.
So where exactly are all these global opportunities? Let's map out the landscape a bit. Because international markets, they're not just one big thing. They're actually divided into some really distinct categories.
We can really break the world down into three clear buckets. You've got developed markets, which give you stability. Then you have emerging markets, which offer that high growth potential, fueled by a rising consumer class. And finally, you have frontier markets. These are your high-risk, high-reward plays, kind of like venture capital, but for entire countries.
Now, of course, going global isn't without its own set of challenges. So let's tackle the two biggest questions that investors always have: China and all the other key risks you got to think about.
Let's start with China. It's a classic two-sided coin. It presents this incredible opportunity, but also a pretty significant set of risks. On one hand, you have this massive growing consumer market, but on the other hand, you have totally unpredictable regulation and some serious geopolitical tensions. You really have to weigh both sides carefully.
And one of those key risks is something called the VIE structure. And this is critical to understand. When you buy many US-listed Chinese stocks, you don't actually own a piece of the company itself. What you own is a shell company that has a contract with the real company. It's a legal workaround that, it carries its own unique risks.
So beyond China, these are the main risks you got to be aware of. But the key here isn't to be scared of them, it's to manage them. And the absolute best way to do that is through broad diversification, spreading your money across tons of different countries and companies so no single risk can sink your portfolio.
Okay, so how do you actually put all this into practice? Let's walk through a really simple, effective framework to get started building your own global portfolio.
And here's the great news. It is easier now than it has ever been. For most people, the simplest way is a single, low-cost ETF, an exchange-traded fund. Just think of it like a basket that holds thousands of international stocks, giving you instant diversification with just one click.
And hey, here's a pro tip that can save you real money. International investing comes with this valuable tax benefit that a lot of people just miss out on. It actually lets you reclaim taxes that were paid to foreign governments.
So the key takeaway here is pretty simple. Where you hold your assets really matters. By placing your international stocks in a regular taxable brokerage account instead of a retirement account like an IRA, you can actually claim this credit and boost your after-tax returns. Pretty cool, huh?
So putting it all together, here's a real-world example of what a balanced, globally diversified stock portfolio could look like. A key feature here is that 40% of the total is allocated outside the US, and it's split between those developed and emerging markets we talked about.
You know, ultimately, the evidence is pretty clear and the takeaway is simple. While there are no guarantees in investing, geographic diversification is probably the most powerful tool you have for improving your returns while reducing your risk over the long haul. It's the closest thing to a free lunch you're going to find.
So we'll end with this thought. Betting that the winner of the last decade is automatically going to be the winner of the next decade, that is a dangerous game to play in investing. The smartest move you can make today is to prepare your portfolio for a global future, because you just never know where the next big opportunity is going to come from.